Hello, everybody. Welcome to the third webinar in our Fall 2022 Global China Research Colloquium series, hosted by the Boston University Global Development Policy Center. The Boston University Global Development Policy Center, or the GDP Center, is a university-wide research center that works to advance policy-oriented research for financial stability, human well-being, and environmental sustainability across the globe. My name is Cecilia Springer. I'm the Assistant Director of the Global China Initiative at the GDP Center, where I also lead our energy and climate change related research. But today we'll be talking about a topic related to China's overseas economic activity and its increasing diversification in recent years. So China's overseas economic activity is diversifying beyond official development finance from its two main policy banks, the China Development Bank and the Export-Import Bank of China. Despite the array of various debt, equity, and grant financing mechanisms that China's policy banks have at their disposal, separate multi-stakeholder funds have emerged that are increasing China's financing capacities for overseas development projects. Since the mid-2000s, Chinese public and private financing institutions have established these specialized investment funds that primarily provide equity financing to sector and region-specific development projects. We call these Overseas Development Investment Funds, or ODIFs, and they are an increasingly mentioned feature of China's foreign direct investment and Belt and Road Initiative financing instruments. A new working paper from the GDP Center explores the unique features, financing capacity, policy implications, and future potential of China's so-called Overseas Development Investment Funds. Two of the co-authors join us today to discuss the findings. They are Oyen Tarala do Moses, or Tarala, the data analyst and database manager for the Global China Initiative at the GDP Center, and Laura Gormley, a research assistant for the Global China Initiative at the GDP Center. So my co-authors will present for 30 minutes, at which point we will open the discussion for Q&A. So before turning it over to Tarala and Laura, I want to mention that this webinar is being live streamed on YouTube, so a recording will be immediately accessible. Please use the Q&A box located in your Zoom menu to ask your questions. And when you do that, please also give your name and affiliation so we can get to know each other. We will take questions after Tarala and Laura's remarks, but please feel free to enter your questions at any time during the discussion. I'll start to collect them. Thank you. And now over to you, Tarala and Laura.
Thank you, Cecilia. Let me just take a moment here to share my screen and share our slideshow here. Great. So as Cecilia mentioned, we're looking forward today to share with you our findings from our paper, China's Paid-in Capital, China's Overseas Development Investment Funds. I will briefly just go through our background and context underlying this paper. Laura will walk you through our methods and findings, and then I will give an overview of our policy implications. So at the GDP Center, specifically in the Global China Initiative, when we think of China's overseas economic engagement, we primarily focus on China's overseas development finance from the China Development Bank and the Export-Import Bank of China. And according to our China's overseas development finance data set, we have seen that from 2008 to 2019, these two policy banks have provided almost $500 billion in development finance to development projects all across the world. We did see that this finance peaked in 2016, and since 2016, there has been a decrease over time. So we sought out to explore, this context a little bit more and think through what are some other emerging financial instruments that have shown themselves while this development finance from these two policy banks has decreased over time. And what we observed are these special investment funds. So some examples that some of you may recognize include the Silk Road Fund, the China, Latin America, and Caribbean Cooperation Fund, the China CEE Fund, and I believe that is specific to Central Asia, and the China Africa Development Fund. And we found that these funds have kind of showed up since 2007, and they continue to increase in terms of funds that were available and established each year until 2019. And as we collected information on these funds and the years that they were established, we found that altogether they represent 155 billion in available capital for overseas development projects. So we set out to categorize these funds, to codify them, and track them in a way that was easy to understand for us as researchers. And when we did, we defined these funds as pools of capital, often established by multiple public and or private shareholders that primarily provide equity financing to certain regions and sectors overseas. And again, we named these Overseas Development Investment Funds, or ODIFs, as an acronym. And some of the unique characteristics we found about China's ODIFs is that, similar to development finance institutions, such as the China Development Bank, China's ODIFs tend to have a development-based mandate. They not only focus on making profits from their investments, but a lot of ODIFs focused on making sure that there's a social and economic impact that comes from the project that they finance. We also found that China's ODIFs have multiple shareholders that are involved in the funds that, again, pay in capital and create a fund structure that comes from, again, this paid in capital for multiple shareholders. And then we also found that these funds primarily wield equity finance. Some of them even provide debt for equity as well. And so we say these four attributes distinguish these funds from other tools that China and different Chinese institutions have used to support overseas development projects. We further categorize ODIFs by breaking them down into three different fund categories. The first fund category we created is a sovereign development fund category. And this is defined as an investment fund that supports overseas development. What distinguishes SDFs from the other two types of ODIFs is that all their shareholders are state-owned. And then, as mentioned, of just generally the types of finance that ODIFs provide, SDFs provide equity and debt for equity investments. Then we have the private equity fund, which is similar to any commercial private equity fund. And we found that if the source describing this fund claimed that this was a private equity fund, we put it in this category. And if not, we looked for these specific features, that this private equity fund supported overseas development. It had limited partnership shareholders, meaning that the shareholders were only in the fund for a certain amount of time, which that time would be considered a fund life. And this fund also provided equity and debt for equity investments as well. And then lastly, the last fund type we put together was a joint investment fund. And this is a fund that is co-established by China and a Chinese institution and a host country institution. It provides equity and debt for equity investments, and it's neither categorized as an established private equity fund, and it doesn't have the attributes of a sovereign development fund. So just to give you an example of what some funds that we found are, and also what categories they fall into, we just wanted to provide this slide. And again, you will see funds that look familiar. And for example, the Silk Road Fund, we classified that as an SDF, mostly again, because all of its shareholders are state-owned, along with the other attributes of ODIFs. And then Going to the private equity fund, we classify the last one on this list, the Green Silk Road Fund, in this category. It's owned by multiple private shareholders and will provide more information and background on the GSRF later on. And then joint investment funds as well, such as the China-Mexico Fund, Russia-China Venture Fund, which are established between China and the host country or host regional institution. So with that being said, I'll pass it over to my colleague, Laura, to walk us through our methods and findings.
Thank you, Tarola. I'll now introduce the methods that we use for data collection and analysis. We drew on the existing literature of financial instrument classifications to determine a set of indicators to guide our data collection and analysis. Next slide, please. We selected indicators that would provide a representative picture of the characteristics and operation of the funds. To assess the scale of ODIFs finance, we looked at capitalization amount as of 2022. Reporting transparency on the funds is generally low, with information on investments only available for featured projects and limited information on total disbursements. Therefore, capitalization serves as the main quantitative metric that we used for assessing the scale of the funds. Year established records the year of the fund's initiation. We also classified the funds into different sectors of investment focus. We also made the distinction between funds and sub-funds. Sub-funds are capitalized entirely from the paid-in capital of another fund. For this reason, we exclude their quantity of paid-in capital from our headline totals to avoid double counting. Shareholders include all the entities who financed multiple funds, who finance a fund at any point. In many instances, the shareholders also participated in the investment review and approval process and fulfill other managerial responsibilities. We identified 4 types of shareholders, which include policy banks, central banks, forex managers, and foreign shareholders. The funds also target either a single country to make investments, or they have a broader regional or global focus, like the Silk Road Development Fund. ODIFs are distinguished from other financing instruments by their provision of equity finance or debt for equity, as Tarola mentioned. Therefore, funds solely established to allocate debt financing or grants are excluded from our sample. Some of these funds are the Africa Growing Together Fund and the South-South Climate Cooperation Fund. Our data methodology builds on existing research on collecting data on China's overseas financial flows and the double verification standards used in China's overseas development finance database. Next slide, please. So first, we identified each fund by consulting existing regional databases of BRI supporting financial institutions. And generally, we found that there were studies on financing tools that mentioned few funds active in the region. However, there was no comprehensive data set of ODIFs. After we collected information from primary sources, including websites belonging to funds and their shareholders and government sources, then we cross-checked this data to the extent possible by comparing information from the sources of Chinese and foreign shareholders and also cross-checking with academic and press sources. Fund reporting on management operations and investment activities is low, which is unsurprising as low transparency is characteristic of this subject area. Next slide, please. I will now discuss the key findings of this paper. Next slide, please. So we found that the funds in our data set represent a total of 155 billion in capitalization, excluding sub-funds. For comparison, the China's Overseas Development Finance database identifies 462 billion in policy bank financing between 2008 and 2019, which is a comparable timeframe to the period of initiation of the funds in our sample. The comparison illustrates the point that while capital available via ODIFs does not exceed China's policy bank financing, it does represent a sizable pool of capital that is worth investigating further. Next slide, please. We found that the funds in our data set were capitalized between 2007 and 2019. This big jump we see in 2014 is primarily due to the initiation of the Silk Road Fund, which added an additional 54.5 billion to the total capital that year. Next slide, please. Here you can see a breakdown of each type of fund according to our classification. Although there were fewer sovereign development funds, their larger total capitalization is driven by the classification as a Silk Road Fund as an SDF. Joint investment funds are the most frequent type of ODIF in our data set. A higher number of joint investment funds might be reflective of Chinese investors partnering with local investors to better originate, structure, and manage investments, as well as navigate the regional regulatory environments. Private equity funds have a higher combined capitalization than the joint investment funds at 45.3 billion. Chinese partnerships with regional or local institutions are also prevalent among the private equity funds. Next slide, please. We found that the energy and resources sector had the largest number of funds specifying support for it at 15 funds, followed by general infrastructure. We noted that 4 funds specifically targeted green development activities. Next slide, please. The Latin American and Caribbean region, including funds that are specifically targeted to finance projects in Brazil and Mexico, had the largest potential total amount of capital at 42.2 billion, followed by Europe and Central Asia. Africa and the rest of Asia had relatively fewer dedicated funds and available capital, although they may be destinations for global funds, such as the Silk Road Fund. The amount here at 70 billion is the amount available for funds targeting a global focus. Next slide, please. So here's a representation of some of the most active Chinese shareholders in financing the paid-in capital of these funds, which are highlighted in red. Certain trends emerge from the patterns of ODIFs shareholder structures. Some funds are entered into as joint agreements between actors who retain a predetermined ratio of capitalization. For example, the China-UAE Joint Investment Fund and the Russia-China Investment Fund are both financed at a 1-to-1 capitalization ratio between a Chinese partner and a foreign partner. If these funds increase their paid-in capital, they're intended to maintain these ratios. In other cases, one shareholder acts as an anchor investor who attracts additional capitalization from other partners. This is the case for the China-ASEAN Investment Cooperation Fund, in which the China Export-Import Bank acted as an anchor sponsor with a seed investment of 300 million. Shareholder composition is also not always static. Certain funds have gone through rounds of refinancing in which old sponsors exit and new ones enter. In the case of the China CEE Fund, China Exim and Hungary Exim supplied the first tranche of financing. In the second tranche of financing, the sponsors expanded to include additional contributions from the Silk Road Fund and CEE Equity Partners Limited, which is another investment fund. Because equity investments are a purchase of ownership in a project, company, or asset, the composition of the shareholders of the funds provides insight on ownership over foreign assets. So ODIFs create a unique space in which sovereign-backed institutions such as China's policy banks and state-owned commercial banks partner with private sector or foreign actors. Through this format, ODIFs allocate the negotiation decision-making process between Chinese and foreign or private shareholders internally to the fund's management team. This presents a departure from many of the other actors participating in China's overseas development finance. Next slide, please. I will now expand on 2 case studies of different types of funds, one private equity fund and one joint investment fund. Private equity funds tend to be explicitly known as private equity funds and are established through a limited partnership, often with commercial institutions. The Green Silk Road Fund was established as a private equity fund to support BRI projects aimed at improving environmental conditions along the BRI and mitigating climate change in China and host countries. Next slide, please. Unlike joint investment funds, private equity funds typically designate how much risk each investor takes for the duration of the fund. They also tend to have a limited partnership shareholders with a defined fund lifespan. So the Green Silk Road Fund was established as a limited partnership structure to provide equity investments with a fund lifespan of 10 years. Shareholders of the fund include several non-state-owned Chinese enterprises and the administrative committee of the Sino-Singapore Tianjin Eco-City, which is a local government entity. The fund primarily targets the green development industry with a focus on clean energy, land restoration, and agriculture. Given the Green Silk Road Fund's mandate to implement aspects of greening the Belt and Road Initiative, the Green Silk Road Fund and investments in domestic and overseas green development has potential to expand within the coming years. Next slide, please. We'll now look at the China-UAE Joint Investment Fund. Joint investment funds represent Chinese institutions joining together with regional institutions to boost investment in the host country, with chances to learn from local institutional knowledge brought on by the local partner. Next slide, please. The China-UAE Joint Investment Fund was established as a platform for co-investments between the China Development Bank, SAFE, and the Mubadala Investment Company, which is an investment fund owned by the Emirati government. The fund's goals are to deepen cooperation between China and Arab countries and advance key development initiatives of the two participating governments, China's Belt and Road Initiative and UAE's Abu Dhabi 2030. The fund is managed by Mubadala Capital's Sovereign Investment Partnership team, and a team composed of both Mubadala and China Development Bank employees source and conduct due diligence. So the operations of the fund are conducted by a partnership team of stakeholders from each partner. So the fund is also capitalized by equal contributions from Mubadala and CDB of each 5 billion, with a total capitalization of 10 billion. These funds are representative of China's ODIFs in 3 ways. They're established through a multi-shareholder structure. They all use equity as the main feature of their financial toolkits, and they serve a general public policy purpose of strengthening economic cooperation between China and other regions through financing development. I'll now turn it back over to Torella to discuss the policy implications.
Thank you, Laura. So I'll now go into the policy implications of our data set. So as we mentioned earlier before, Chinese development finance has been in decline, and this decline may accompany a diversification of finance, specifically using ODIFs and other financial instruments, which shows the importance of putting together this data and understanding how we can codify ODIFs. We also notice that in several policy documents, ODIFs have showed up. For example, when China released some guidance on greening the BRI, they mentioned several equity funds as instruments that could be used to support projects for the purpose, or to support greener projects. And we also found in the FOCAC, or Forum on China-Africa Cooperation, Dakar Action Plan, several ODIFs were mentioned, as well as the importance and use of just equity in general to support different development projects in the region. We also see a third factor as potentially being kind of the impetus for the rise of ODIFs, and that could be the Global South demand. As many of you may be aware, several countries are grappling with debt distress or the risk of debt distress, and may consider alternative forms of finance for development, such as public-private partnerships. But these countries also need to assess some advantages and disadvantages with going into public-private partnerships or working together with ODIFs, should they see ODIFs as a good alternative to policy bank finance. And as I mentioned in the previous slide, when you look at IMF data specifically on debt distress, 54% of low-income countries, so these are countries that would be eligible for a concessional finance, are in debt distress or in high risk of debt distress. So these are the countries that could potentially consider equity finance through the use of ODIFs as an alternative. But again, when you look at the advantages and the disadvantages, I think each country kind of has to weigh these based on their own development goals. Some advantages that they could consider is that it's not debt, so it would not contribute to the level of debt distress that their country is in. And then the interest gained on a project is dependent on the performance of the asset and not dependent on repayment or credit background specifically. And so each project can be in isolation of itself rather than be connected to a country's ability to repay, but the project itself should be able to repay for itself should it be successful. But some disadvantages that countries would need to consider is that the government must share ownership of this asset. And I think this is something that governments should consider, especially when it is a public asset. And then the profits of the asset must also be shared, because profits need to pay back all the shareholders who provided equity for the asset. And lastly, private institutions or more commercial focused institutions may have different goals from public entities that are involved in kind of a public-private partnership structure for supporting development projects. Private and commercial institutions may be more profit-driven and focused on that, whereas the public institutions may be more focused on providing public goods. So there has to be a balance of those goals and interests as well. But I think our paper contributes to continuing to think of ways that other types of China's economic engagement may emerge and potentially influence the amount of finance that's available for development projects across the world. So we thank you for your time, and we look forward to your questions.
Great. Thank you so much to Tyrella and Laura for presenting this research. I want to encourage the audience to go ahead and put your questions in the Q&A box at the bottom of your Zoom menu. And please also share your name and affiliation. We've got a few questions, and before we get to them, I just want to highlight, what I, as also as a co-author on this paper, see as a main contribution of our research, which I think is to put forward this definition of overseas development investment funds, and then also provide a taxonomy for kind of understanding them and placing them in the context of China's overseas development related activity, as well as emerging forms of financing. So I think it's quite useful if you go ahead and check out the working paper to distinguish. We've distinguished the similarities and differences between ODIFs and development finance, and also looked at similarities and differences between the different types of funds that we also classified. So the sovereign development funds, the private equity funds, and the joint investment funds. There are a few studies already out there about China's overseas funds, and I think we build on this sort of small but growing literature, which has previously included a number of case studies. So we add some additional case studies, but again, I think the main value is this comprehensive and systematic quantification effort that we underwent. And Laura walked you through the methodology on that came up with this total capitalization number, which is a really important point of reference for the scale that these funds could invest at. Great, so let's move into discussion. And again, please go ahead and enter your Q&A at this time. Our first question is from Karen Zhu, who is one of our postdoctoral fellows here in the Global China Initiative. And Karen asks two questions. First, for China and host countries, are China-backed loans and ODIFs alternatives with each other, or are they complementary to each other? And then second, what are some of the drivers behind the growth in Chinese ODIFs? Is the primary driver China? Is it host countries or other actors? And then our second question is from Jerry Harris from the Global Studies Association. And Jerry asks, what are some of the largest foreign investors? So I'm guessing foreign shareholders in these funds. So I'll turn it back to the researchers and we can start with these questions. Thank you.
Great, thank you, Cecilia. I can take the first two, and then Laura, I'll pass it to you to focus on the foreign shareholders. So I think Karen's question is very interesting because yes, I think they can be both alternatives and complementary, meaning that if you have a large enough project, it could have Chinese-backed loans that are provided for the projects, but an ODIF could also provide the equity portion of a project as well. So I think the complementarity versus being an alternative depends on the size of the project, how large it could be, because most equity funds generally tend to support projects that are smaller in terms of value size. And I think it also depends on the demand of the host country. If the host country prefers to go into, prefers to take on equity for a project versus wanting loans specifically. And then I also think risk is also an important thing to think about, but more so from the point of financial risk for the different financiers of a project. When you have multiple financiers, whether it's through having loans on the project and equity on the project, there's more of an opportunity to spread the risk or spread the exposure for financiers in terms of if a project is successful or not, how much returns they can get back on their investments. And so I think when we think about complementarity versus alternatives, I think financial risk is something to think about as well, which also is connected to the second question that Corinne asked about who is behind the growth of these funds. And I would say it's primarily China and Chinese institutions. I believe there is a desire, again, to find ways to diversify risk, find ways to be innovative about financing, especially for overseas development projects. And so with that being said, and the rise of China's development finance that was underpinned by the Belt and Road Initiative, I think ODIFs have just contributed to a desire to, again, innovate and find different financial instruments to support projects. So I'll pass it over to Laura now.
So to discuss the largest foreign shareholders, actually, would it be possible to pull up the slides again for the shareholder side?
Sure, let me get that for you. Can you see it?
Yep, thank you.
Okay.
So some of the largest foreign shareholders we see participating in ODIFs are the Hungarian Exim Bank, which is up here in the top right corner. And we also see the CLAI fund, which is backed by the Brazilian Development Bank. And another key foreign investor is the Russian Direct Investment Fund, which is down here on the bottom right corner, which primarily invests in country-specific funds that are targeted at projects in Russia. So it's also interesting to note that in some cases, funds act as funds finance other funds. So the Silk Road Fund has actually financed the China-Kazakhstan Fund, which has $2 billion in capitalization, which is substantial. And also the Russian China Investment Fund has participated as a shareholder in investing other funds.
Great. Thank you for answering that first round of questions. We have many more. The first question that I saw was from Manuel, and Manuel asked, is there a link where the paper can be downloaded? Yes, I shared that link, and it's also the first link shared in the Q&A box. So I encourage everyone to check it out and download the paper. Our next question is from Gianluca Sampaolo. And Gianluca asks, how will China's ODIFs behave against the backdrop of China's dual circulation strategy and China's objectives towards technological autarky and a general shift towards domestic priorities? So China's domestic dual circulation, for those who may not be familiar with it, is a recent strategy raised in China's 14th five-year plan to prioritize both domestic consumption within China as well as encouraging international investment into China and trade, so kind of an economic strategy. So the question again, how will China's ODIFs behave as China continues to focus on its own domestic priorities? The next question that I'll pass to our researchers is from Rebecca Ray. Rebecca Ray is a senior academic researcher here at the GDP Center. And she thanks us for an accessible introduction to this often discussed but little known area of BRI finance. To the researchers, do you think that these funds have an advantage in the sector of renewable energy finance, which often takes longer to become profitable than the length of the sovereign loan? Have you seen any evidence of them being popular sources of finance for this type of project? So I'll turn it over to the researchers and could also elaborate on the renewable energy discussion at the end.
Great. So I can take the first question about how ODIFs kind of fit into China's dual circulation strategy, as well as some domestic priorities. I think, yes, there is an extent to which China is thinking of ways to kind of depend on domestic kind of economic growth, but at the same time still pursue some of this growth that they have gained from overseas economic engagement. And I think within that framework, given the fact that we've seen multiple mentions of ODIFs within different policy documents, it does look like the Chinese government would like to encourage the use of more ODIF type financing. This is specific to the 2019 BRI forum, where there was a deliverable session, and China asked if there could be multiple deliverables specific to the Silk Road Fund. And since 2019, again, we've seen ODIFs show up in several documents after that. So it does look like ODIFs will be a part of at least the outward focus of this dual circulation strategy, and will accompany other, again, financial tools that China is seeking to use other than policy bank type finance. So I'll pass it on to Laura or Cecilia to tackle the renewable energy question.
I can speak just broadly to the advantages that ODIFs present to investing in a sector that might be difficult to secure other types of financing, generally based on the financial instruments they offer. So as Terrell mentioned before, they offer more flexibility in financing structures by providing an alternative entry to the projects besides debt or grant financing. They also have the advantage of close cooperation with local stakeholders, and this provides greater insight into the market that might be useful for maneuvering an investment that would to better risk management of the investment for it to succeed.
Great, and yeah, I'd also, as a co-author on the paper, like to respond to the question about renewable energy just briefly. Several of the funds in our data set were earmarked for green development activities. And as Tarla mentioned, there was a March 2022 multi-ministry guidance from China that specifically mentioned funds as a mechanism for increasing support for green and low carbon energy overseas. So while we didn't see specific projects that had been financed in this way before, they may be out there. But I think it's a tool that could really come to the fore in the future as China starts to think about delivering on its commitments to overseas green and low carbon energy. Great, so let's take another round of questions. It's great to see so many, so thank you to the audience and keep them coming. So from Martin Thorley, postdoctoral fellow at the University of Exeter in the UK, Martin asks, in the course of your research, did you get a sense of how the funds you investigated might impact crime, for example, corruption, in comparison to better known pre-existing platforms? We also have a question from Dr. Yan Wang from the GDP Center, and she asks, this is a useful study, and it would be quite useful to have a comparison with the IFC and the World Bank Group and Singapore's GIC and Temasek. Yan says she thinks China is trying to learn from the experiences of the above institutions. The potential of these ODIFs is tremendous for public-private partnerships and infrastructure. Do you think these funds could play some role in debt to equity swaps? And then I'll just throw in one more question. My name from Tybin Elston. Hi, my name is Ty, and I work for AidData. Thanks for joining us, Ty. AidData and TaiBin also compile a data set on Chinese development finance. So what are the patterns of success and or failure for the projects financed by these special investment funds, by the ODIFs? Are they more profitable or effective than typical debt finance projects from the China Development Bank or the China Export-Import Bank? So 3 questions. First, again, from Martin about crime or corruption, comparing to pre-existing platforms. Second, from Jan about funds playing a role in debt to equity swaps. And then third, from Tai about patterns of success and failure and whether ODIFs may be more profitable or effective than typical debt finance projects. So a bunch of tough questions. Over to the researchers.
Yeah, thanks, Celia. So just for the first question, unfortunately, we did not look specifically as to the impact of ODIFs on crime. Just for everyone's general understanding is that we look to identify the funds. However, there was kind of limited data available for tracking things like disbursements and impact as well. So that's definitely an area of new research opportunities for those who are looking to understand ODIFs better, finding ways to track their disbursements and track the type of projects they support that is comprehensive and robust. So with that being said, towards the second question, I think, yes, there is an opportunity for us to compare these ODIFs with the World Bank Group's kind of IFC finance. And I know the World Bank Group, they have a PPP data set. I think it'd be interesting to kind of look and see if we were to have, you know, a list of projects that ODIFs have supported, to look and see and compare those projects with those from the World Bank Group. And then again, just to the question on success or failure of these projects financed by ODIFs, again, because we did not necessarily just track disbursements and because there's limited public data available for which projects ODIFs have supported, that's just not something we focused on in the confines of the paper, but again, is an opportunity for further research. Laura or Cecilia, please feel free to add if there's anything else that you would like to contribute.
Nothing from my end. So let's move on to the next round of questions. And possibly the last round, unless folks in the audience have more questions, go ahead and answer them or ask them, and then we'll answer them. So first is from anonymous attendee who says, fantastic paper. Thank you. Do ODIF types differ based on characteristics of the host country economy in terms of income level and level of financial risk, for example? Then we also have a question from Barry Herman. Barry asks, you show a rapid buildup of the capital in the funds in the 2010s. Do the funds anticipate expanding their capital via retained earnings, or will they distribute all the earnings to the shareholders? Are there any plans for new equity in the funds themselves? And is there any sense if the policy on these funds has been changed by the recent government conference? I'm guessing this means the 20th Party Congress that happened last month in China. So over to the researchers.
Yeah, again, very interesting questions. I think for us, when we looked at the joint investment funds specifically, that again looked at funds that were established by Chinese financial institutions and host country government institutions, there wasn't necessarily a distinction that we found between these, depending on the income level or even the kind of other factors that were related to the host countries. I think the main attributes that distinguish GIFs from other ODIFs is that, again, that they are established with a regional institution, and that gives the opportunity for the ODIF to better navigate the regional environment as well as the country environment if needed, and kind of lean on the partnerships and experience of the host country or regional institution. So I will stop there and then hand it to Laura to tackle the second question.
So thank you for your question, Barry. So we have seen cases in which the funds set an initial goal capitalization that is then increased in later years. We also see the opposite as well, where the goal capitalization of the fund is set from the initiation, but then it's never met. So what's interesting to see is how the additional capitalization might bring in new shareholders, or if it also might reflect the fund's success in the investments that it's already made. So there's definitely a diversity in the outcomes of the funds in terms of if the investments are dispersed and the fund closes versus if the fund is recapitalized. And any sense of the policy of these funds is changed by recent government. The funds would fall under the recent guidance on outbound investment restrictions as pertaining to the state-backed entities that act as shareholders for some of them.
Great, thank you both. So let's keep it short and sweet today. Thank you to the audience for providing so many excellent questions. And I want to also thank Tarala and Laura for sharing their thoughts with us today. And so this colloquium has been recorded on YouTube, and we will share the link in the chat. Please be sure to join us again next month for the next installment of the Global China Research Colloquium. We will be discussing COVID-19 and sovereign debt, the case of the Southern African Development Community. So if you registered to attend this session, you are signed up for the rest of the series, so you'll automatically receive the link to the webinar. And we really hope to see you again next month. I also wanted to note that the Global China Initiative is currently recruiting for fellows. So we support pre- and postdoctoral fellows to come join us and support their dissertation research, as well as contributing to GDP Center projects. So please apply. Applications will close next month. And lastly, to receive updates on our publications and events, you can subscribe to our Global China Initiative newsletter, which is a great way to stay in touch. So thank you, everybody. Thank you, Tarala and Laura, and we'll see you next time.